$938 billion. That is the exact amount of U.S. Treasury debt held between mainland China and Hong Kong as of the most recent Treasury International Capital data. And as of the second week of February 2026, Beijing has officially ordered its banks to begin dumping it. This is not a rumor. This is not speculation from some fringe blog. Bloomberg confirmed it. Reuters confirmed it. Chinese regulators have directed financial institutions to limit new purchases of U.S. government debt and instructed those with heavy exposure to pare down their positions immediately. That $938 billion is not just a number on a spreadsheet. It is a loaded financial weapon aimed directly at the heart of the American bond market, the American housing market, and ultimately at every single dollar sitting in your savings account, your retirement fund, and your checking account right now. For the first time in modern history, the country that financed America's spending addiction for 3 decades has officially moved from partner to adversary in the sovereign debt arena. The arrangement that powered global finance, where China manufactured goods, earned dollars, and recycled those dollars back into U.S. Treasuries to keep American interest rates low, is fracturing in real time. And if you thought inflation was bad, if you thought higher mortgage rates were painful, if you thought the cost of groceries eating into your paycheck was the worst it could get, you are not ready for what comes next. Because when the second largest foreign holder of your nation's debt starts selling and stops buying, the consequences do not arrive in months. They arrive in days. The bond market moves at the speed of fear. Before we go any further, if you are serious about understanding what is happening to your money and your future, subscribe to this channel right now and turn on notifications so you do not miss a single update. And drop a comment below, one word, gold or dollar. Tell me which one you think survives what is coming. Let us see where this audience stands. To understand the magnitude of this threat, we have to look at a number that almost nobody in mainstream financial media is showing you. The headline figure that most analysts cite for China's treasury holdings is approximately $682 billion. That is the official number from the Treasury Department for mainland China as of November 2025. It sounds concerning but manageable. Here is what they are not showing you. When you add Hong Kong's holdings, which function as an extension of China's financial system and are deeply intertwined with mainland capital flows, the combined figure jumps to $938 billion. And even that number is likely an undercount, because China has been known to hold treasuries through custodial accounts in Belgium and Luxembourg, through offshore entities and sovereign wealth fund proxies that do not show up in the official bilateral data. Some analysts at Seeking Alpha estimate that China's true exposure, when you include all indirect channels, could still be significantly higher. Most analysts ignore this. They look at the $682 billion mainland figure, compare it to Japan's larger holdings, and tell you not to worry. But they are missing the strategic picture entirely. Here is the history you need to understand. After China joined the World Trade Organization in 2001, a symbiotic financial relationship emerged between Washington and Beijing that was arguably the greatest financial arrangement in modern history. China manufactured goods cheaply, exported them to American consumers, accumulated enormous dollar surpluses, and then recycled those dollars back into U.S. Treasury bonds. This did two things simultaneously. It kept the yuan artificially weak, making Chinese exports even more competitive, and it kept American interest rates artificially low, allowing the United States to borrow and spend far beyond its natural means. This cycle powered the global economy for over 2 decades. American consumers got cheap goods. China got industrial growth. The U.S. government got a reliable buyer for its debt. Everyone seemed to win, but as of this month, that arrangement is officially dead. On February 9, 2026, Bloomberg reported that Chinese regulators had instructed banks to curb their exposure to U.S. Treasuries, citing concentration risk and market volatility. Within days, Reuters confirmed the directive. The Atlantic Council published an analysis noting the timing was too conspicuous to ignore, coming just days after a leading Chinese Communist Party journal published a speech by President Xi Jinping calling for the internationalization of China's currency. The transition from America's banker to America's financial adversary did not happen overnight, but the formal order to begin the retreat has now been given. And there is no going back. This is why what happens next follows a chain of consequences that most people are completely unprepared for. Let us start with the first and most direct crisis: the bond market itself. When China sells U.S. Treasuries or even just stops buying new ones, it removes a massive source of demand from the world's most important debt market. The United States needs to issue roughly $1.9 trillion in new debt this fiscal year alone, according to the Congressional Budget Office's latest projections published just days ago. That is $1.9 trillion that needs to find a buyer. When one of your largest buyers steps away from the auction, the remaining buyers demand higher yields to compensate for the risk. Higher yields mean higher interest rates across the entire economy. This is not theory. This is basic bond math. When the price of a Treasury bond falls because there are fewer buyers, the yield rises. And that yield is the benchmark for nearly every borrowing cost in the American economy. This is why your mortgage rate, your car loan, your credit card interest, and your small business line of credit are all tied, directly or indirectly, to what happens in the Treasury market. Now let us follow the chain to the second crisis. Higher Treasury yields mean higher mortgage rates. The average American is already stretched thin. As of early 2026, the average 30-year fixed mortgage rate has been hovering in the mid-6 to low 7% range. If China's withdrawal pushes the 10-year yield, currently around 4.05%, back toward 5% or beyond, mortgage rates could surge past 8%. At 8% on a $400,000 home loan, your monthly payment is roughly $2,930. At 6.5%, that same loan costs you $2,828. That is an extra $407 per month, almost $5,000 per year, coming directly out of your paycheck. And that is just the mortgage. This is why the housing market is the first civilian casualty on this battlefield. Sales freeze. Prices stall or fall. Homeowners who bought at the peak find themselves underwater. Construction companies lay off workers. The entire real estate ecosystem, which accounts for nearly 18% of U.S. GDP, enters a siege. The third crisis layer is the U.S. government's own interest expense. The federal government is already paying over $1 trillion per year just in net interest on the national debt, which now stands at approximately $38.5 trillion. The CBO projects this will more than double to $2.1 trillion annually by 2036. But those projections assumed a relatively stable buyer base for Treasuries. If China's exit forces yields higher by even 50 basis points across the curve, the additional annual interest cost to the federal government could be measured in hundreds of billions of dollars. They know this. Treasury Secretary Scott Bessent knows this. The Federal Reserve knows this. Every single fiscal projection depends on the assumption that there will always be willing buyers at reasonable rates. China just challenged that assumption in the most public and deliberate way possible. This is why the fourth crisis emerges: the deficit doom loop. Higher interest payments mean larger budget deficits. Larger deficits mean the government must issue even more debt. More debt issuance with fewer buyers means even higher yields. Higher yields mean even larger interest payments, and the spiral tightens. This is exactly what happened to the United Kingdom in the autumn of 2022, when the Liz Truss mini-budget caused a bond market revolt. Gilt yields spiked, pension funds nearly collapsed, and the Bank of England was forced to intervene with emergency bond purchases within days. But the UK bond market is a fraction of the size of the US Treasury market. If a similar loss of confidence hits the $30.9 trillion market for publicly held US debt, the blast zone would be global. This is the negative feedback cycle that keeps fiscal analysts awake at night. Crisis A, China selling, causes crisis B, higher yields, which causes crisis C, larger deficits and more debt issuance, which feeds back into crisis A by making treasuries even less attractive to remaining foreign buyers. It is an inescapable spiral, and the entrance door just swung open. The fifth crisis layer is the dollar itself. China is not just selling treasuries, it is actively replacing them. The People's Bank of China has been buying gold for 15 consecutive months. In January 2026 alone, China added another 40,000 troy ounces to its reserves, bringing its official gold holdings to 2,308 tons, representing 9.6% of its total reserve assets. The value of China's gold reserves surged to $369.58 billion in January, up from $319.45 billion just 1 month earlier. They know what is coming. They are converting paper claims denominated in dollars into physical metal that no government can print, freeze, or sanction away. And they are not alone. Central banks globally purchased over 1,000 metric tons of gold in both 2023 and 2024, and JP Morgan estimates demand will average 585 tons per quarter in 2026. Gold has already breached $5,000 per ounce this year, hitting a record above $5,100 in late January before a sharp correction. This is why gold is not just rising. It is being stockpiled by the very institutions that understand what the destruction of the Treasury recycling system actually means for the dollar's purchasing power. The sixth crisis is the BRICS financial infrastructure being built to replace the dollar system entirely. This is not some distant theoretical threat. In January 2026, India's central bank formally proposed linking BRICS nations' digital currencies to facilitate cross-border trade outside the dollar. Over 60% of BRICS trade now settles in local currencies, not dollars. China's deputy central bank governor, Liu Lei, doubled down in December on new cross-border payment systems, explicitly designed to operate outside Western financial networks. The BRICS payment rail is being laid track by track, and the Chinese Treasury sell-off is not a standalone event. It is one front in a multi-front financial war aimed at dismantling the dollar's reserve currency status. This is a pincer movement. On one side, they sell your debt, driving up your borrowing costs. On the other side, they build alternative systems so the world no longer needs to hold dollars in the first place. Both flanks are advancing simultaneously, and the fortress of dollar hegemony is being besieged from every direction. The seventh crisis layer hits your retirement directly. American pension funds, 401k plans, and insurance companies hold trillions of dollars in treasury bonds and bond funds. When the treasury prices fall because yields are rising, the value of those holdings drops. This is exactly what happened during the Silicon Valley Bank collapse in 2023, when SVB held long-duration treasuries that lost massive value as rates rose, triggering a bank run that destroyed the institution in 48 hours. Now imagine that same dynamic playing out not at one bank, but across the entire institutional bond-holding landscape. You are paying this premium every single month whether you realize it or not. Every time your pension fund's returns come in below expectations, every time your 401k balance stagnates despite years of contributions, part of the reason is that the bonds in your portfolio are losing value in a rising rate environment that China is now actively accelerating. The eighth crisis is inflation. When the dollar weakens because foreign demand for dollar-denominated assets declines, every imported good becomes more expensive. The United States imports roughly $3.8 trillion in goods and services annually. A weaker dollar means you pay more for oil, more for electronics, more for clothing, more for food that is processed or transported using imported components. This is the hidden tax. This is not a tariff you see on a receipt. It is a silent erosion of your purchasing power that shows up in the grocery bill, the gas station price, and the shrinkflation of every product on every shelf. This is why the eighth crisis feeds directly back into the first. If inflation rises because the dollar weakens, the Federal Reserve is trapped in a binary nightmare. Either they raise rates to fight inflation, which makes the debt even more expensive and accelerates the bond market crisis, or they keep rates low and let inflation destroy the purchasing power of every American family. Either way, you lose. Both options lead to the destruction of your wealth. There is no soft landing in this scenario. The ninth crisis is geopolitical contagion. China is not the only nation reducing its treasury exposure. Brazil's holdings dropped from $229 billion to $168 billion in a single year. India fell from $234 billion to $186.5 billion over the same period. These are not coincidences. This is a coordinated withdrawal, a slow-motion bank run on American sovereign debt by the nations that collectively represent over 40% of the world's population. This is exactly what happened during the fall of the British pound as the global reserve currency in the mid-20th century. It did not collapse overnight. It eroded slowly at first, then all at once, as nation after nation diversified away from sterling and toward the dollar. Now the same pattern is emerging, but the currency under siege is the dollar, and the nations doing the diversifying have nuclear weapons, massive commodity reserves, and the world's largest manufacturing base. History does not repeat exactly, but the rhythm is unmistakable. The 10th crisis is what happens when the Federal Reserve is forced to become the buyer of last resort. If foreign buyers retreat and private domestic buyers cannot absorb the massive issuance needed to fund a $1.9 trillion annual deficit, the Fed may have no choice but to restart quantitative easing, buying treasuries with freshly created money. This is monetary debasement. This is how you get stagflation, a stagnant economy with rising prices. This is exactly what happened during the 1970s, and it took Paul Volcker raising interest rates to 20% to kill that inflationary dragon, at the cost of the deepest recession since the Great Depression. But in the 1970s, the national debt was a small fraction of GDP. Today, it is 101% of GDP and heading to 120% by 2036, according to the CBO. The ammunition the Fed would need to fight inflation this time would simultaneously detonate the debt bomb. They know this. Every central banker on the planet knows this. And that is precisely why they are buying gold. So what is the smart money doing about it? Let us shift from what is happening to how the most powerful institutions and individuals on Earth are positioning themselves, because their actions tell you more than their words ever will. China's central bank has purchased gold for 15 straight months and is building payment systems to bypass the dollar. Central banks globally have been net buyers of gold for 3 consecutive years, accumulating over 1,000 tons per year. Gold has surged from around $2,900 per ounce in early 2025 to nearly $5,000 today, a gain of roughly 70% in under 12 months. That is not retail speculation. That is sovereign wealth funds, central banks, and institutional investors making a calculated bet that the current monetary system is entering a period of fundamental restructuring. Meanwhile, billionaires and major fund managers have been quietly reducing exposure to long-duration bonds and increasing allocations to real assets, commodities, energy infrastructure, farmland, and physical precious metals. The distinction they understand, and that most retail investors do not, is the difference between paper wealth and real wealth. Paper wealth is a number on a screen, your brokerage account balance, the stated value of your bond fund, the equity in your home as estimated by a website. Real wealth is something you own outright, something that cannot be diluted, frozen, or devalued by a central bank printing press or a foreign government selling its reserves. Ask yourself this question: how much of your net worth is truly yours, and how much of it is a claim on a promise made by an institution that is currently being besieged from multiple directions? If your retirement isn't a bond fund, you own a claim on U.S. government debt, the same debt China is now offloading. If your savings are in a bank account, you own a claim on that bank's solvency, and we saw in 2023 how quickly that claim can evaporate. If your home equity depends on interest rates staying low, you own a claim on a monetary policy environment that is now being disrupted by the largest creditor nation on Earth. The risks ahead are not limited to what is happening today. Financial repression is the next phase. Central bank digital currencies, or CBDCs, are being developed by over 130 countries. These digital currencies give governments unprecedented control over how you spend, save, and transact. Capital controls, where governments restrict how much money you can move or withdraw, have been used in Greece, Cyprus, Argentina, and Lebanon in recent memory. Negative interest rates, where you pay the bank to hold your money, were reality in Europe and Japan for years. These tools are not conspiracy theories. They are policy options that become increasingly attractive to desperate governments facing a debt spiral they cannot escape through growth or austerity alone. The window of opportunity is still open today. You can still assess your exposure, you can still examine whether your wealth is concentrated in paper promises or distributed across assets that have historically survived currency crises and debt restructurings. Throughout history, whether it was the collapse of the Roman denarius, the hyperinflation of the Weimar Republic, or the more recent crises in Venezuela and Lebanon, the assets that preserved wealth were tangible. Precious metals, productive land, essential commodities, and equity in real businesses that produce things the world cannot live without. The door is still open, but this window will not remain open forever as the crisis accelerates. Every month that passes, the options narrow. Every yield spike, every Treasury auction that draws weaker demand, every central bank gold purchase is another signal that the institutional world has already made its decision. The question is whether you will make yours in time. This is not just a financial decision. It is a decision about identity. Are you going to be the passive observer who watches these developments on a screen and assumes someone else will fix it? Or are you going to be the person who looked at the data, understood the trajectory, and took deliberate steps to position themselves on the right side of the greatest monetary transition in a generation? The difference between those two people is not intelligence. It is not access to secret information. It is willingness to act when the signals are clear, even when the crowd is still asleep. The storm is no longer on the horizon. It is overhead. The rain has already started to fall, and the shelter built on the assumption that foreign nations would always fund American deficits at low rates, that the dollar would always be the unchallenged reserve currency, that interest rates would always come back down, that shelter is leaking. The question you face right now is whether you will build your ark before the flood arrives in full force, or whether you will stand in the rain hoping the clouds clear on their own. The clouds are not clearing, they are thickening. Every data point we covered today, from the $938 billion in Chinese-held treasuries being actively wound down, to the $1 trillion in annual interest payments, to the $38.5 trillion national debt heading toward $64 trillion within a decade, to the 15 consecutive months of Chinese gold purchases, to the BRICS payment systems being erected to bypass the dollar entirely, every single one of these facts points in the same direction. The creditor has made their choice. China is moving with speed and deliberate conviction, converting dollar paper into gold metal, building financial infrastructure outside the dollar system, and explicitly instructing its banks to retreat from American debt. They have looked at the math, and they have decided. The question is, have you? Will you be the creditor left holding worthless paper promises, or will you be the one who owns what the world actually needs when the system resets? The time for complacency is over. The time for action is right now. If this information opened your eyes, share this video with someone you care about. A friend, a family member, someone whose retirement or savings might be at risk. Subscribe if you have not already. Turn on notifications, and understand that this channel is not just content. It is a mission. It is a community of people who refuse to be blindsided by the greatest financial shift of our lifetimes. Together, we can navigate this and emerge with our wealth and our freedom intact. I will see you in the next one.